Welcome back to the Tesla Daily News Podcast. I'm your host, and today is April 7th, 2026. In the next few minutes, we'll break down the most stock-moving Tesla headlines, the delivery and inventory gap, a fresh wave of bearish Wall Street calls, a regulatory update on Smart Summon, and why Tesla's autonomy narrative is heating up right as charging expansion in India adds a little fundamentals fuel. Story 1. Tesla built roughly 50,000 more cars than it delivered, and that's the number investors can't ignore. Here's the setup. Tesla reported first quarter deliveries of 358,023 vehicles, while production came in at 408,386. That's a gap of a little over 50,000 vehicles, effectively inventory that has to be absorbed by future demand, pricing, incentives, or production cuts. Context matters. Deliveries were below many analysts' expectations, which were clustered around the low 370s, roughly 370,000 to 372,000. Missing a consensus print doesn't just hit sentiment, it often prompts revisions to forward revenue, margin, and cash flow expectations. Details. On top of the headline miss, commentary in the investor press is increasingly focused on whether Tesla is producing ahead of demand in its core models, especially Model 3 and Model Y, while the Cybertruck isn't yet scaling to a level that changes the volume story. One report highlighted Cybertruck deliveries around 16,000 in the quarter, which is meaningful but not enough to offset softness elsewhere. Impact. For the stock, a production over delivery gap can become a margin story fast. If Tesla needs to clear inventory, it can do it three ways: higher advertising and demand stimulation, more financing incentives, or price cuts. Historically, investors have treated aggressive price moves as a warning sign for automotive gross margin. Takeaway for investors: watch two things going into earnings. First, whether Tesla discusses inventory explicitly region by region. Second, whether management hints at production pacing in Q2. If production gets trimmed to match demand, it can support pricing power but may pressure near-term growth narratives. Story 2. JPMorgan is out with one of the most bearish Tesla targets on the street, and it's anchoring the conversation. Hook. JPMorgan reiterated a sell rating and a price target of $145, implying as much as roughly 60% downside from the recent trading area. Context. Tesla's valuation has always carried a future business: premium, autonomy, robotaxis, software, energy, and now robotics. JPMorgan's core argument is that expectations for Tesla's operational trajectory have been coming down, yet the stock and many price targets had risen anyway, meaning investors are paying today for improvements that may be far out in time. Details. JPMorgan also revised its earnings view, trimming a 2026 earnings per share estimate down to about $1.80 from about $2. The bank cited competition, higher rates, and a tougher demand environment, alongside the delivery miss. Impact. Even if you disagree with the $145 target, bearish notes like this matter because they can shift the range traders are willing to pay, influence options pricing, and shape near-term narrative in the run-up to earnings on April 22. Takeaway. If you're long Tesla, you don't have to accept the bear case, but you do have to map what would disprove it. In this case, that likely means evidence that demand is stabilizing without further margin-eroding price action, or a credible autonomy monetization timeline that investors can underwrite. Story 3. NHTSA closed its investigation into actually Smart Summon, a small regulatory win, with a bigger autonomy caveat. Hook. The U.S. auto safety regulator closed a 15-month probe into Tesla's actually Smart Summon feature. Context. For Tesla, regulatory overhang is one of the biggest swing factors in autonomy perception. Even when the events are low severity, investigations create headline risk and can influence consumer trust. Details. NHTSA said the incidents tied to Smart Summon were rare relative to the total number of uses, involved low speeds, and had no reported injuries or deaths. Many events involved minor property damage, things like gates, posts, or parked vehicles, and in some cases the camera view was blocked by snow. Tesla addressed issues through software updates, and the agency closed the matter citing low incident severity. Impact. This is supportive for sentiment in the short term. It removes one specific investigation from the list, and it reinforces Tesla's argument that over-the-air updates can reduce real-world risk quickly. But here's the caveat. NHTSA has other ongoing scrutiny around full self-driving, including an escalated review tied to crashes. So this isn't regulatory all clear, it's one resolved item. Takeaway. The market may treat this as a modest de-risking of Tesla's autonomy stack, but the valuation-relevant question remains the same. Can Tesla move from supervised to unsupervised operation at scale? And can it do it on a timeline that justifies today's premium? Story 4. Musk is amplifying FSD safety stats, and Tesla is leaning harder into the autonomy narrative. Hook. Elon Musk reposted Tesla's safety metrics suggesting full self-driving supervised is roughly 7 times safer than the average human driver on a per-mile basis. Context. When Tesla's automotive unit faces demand questions, the company often shifts investor focus to software and autonomy because software margins, in theory, can be structurally higher than vehicle margins. Details. The figures being circulated cite FSD supervised experiencing about 1 crash per 5 million to 7 million miles, compared with about 1 crash per 660,000 miles for human drivers. The claims reference Tesla's vehicle safety reporting and a large real-world mileage base. Impact. For Tesla, this kind of messaging can be a catalyst, not because it changes near-term deliveries, but because it can influence investor belief in a future robotaxi and software revenue stream. However, it also increases scrutiny. Regulators and skeptics will challenge methodology, comparability, and edge cases. Takeaway. Investors should watch for what Tesla says on the April 22 earnings call about autonomy monetization, subscription take rates, pricing, any expansion of supervised capabilities, and whether there's a clearer path to paid robotaxi service. If autonomy remains promising but undefined, the market may keep discounting it. Story 5. Tesla's charging network is expanding in India, and that's a quieter but important fundamental story. Hook. Tesla opened its first in-mall charging station in India at Nexus Seawoods Mall in Navi Mumbai. Context. In a market like India, charging build-out is not just convenience, it's a gating factor for EV adoption and for Tesla's ability to scale sales beyond early adopters. Details. The site includes 8 chargers, 4 V4 Superchargers up to 250 kilowatts and 4 destination chargers at 11 kilowatts. Tesla says a Model Y can add up to about 275 kilometers of range in about 15 minutes on supercharging. Tesla now reports about 20 superchargers and 14 destination chargers across its Indian network, with this being its 4th charging location. Impact. This doesn't move quarterly numbers by itself, but it supports longer-term demand, helps reduce range anxiety, and strengthens Tesla's moat if it can build a reliable charging footprint ahead of competitors. Takeaway. For investors, watch whether Tesla accelerates charging deployment pace in India and whether that correlates with higher Model Y and Model 3 volumes. Infrastructure-first expansion tends to show up in sales only after a lag. Before we wrap, a quick market pulse. Tesla traded down on Monday amid delivery disappointment and fresh caution from analysts, even as broader U.S. indexes drifted higher. That divergence tells you the market is treating Tesla as a company-specific story right now, not just a macro story. That's it for today. Let's recap the themes. First, the production versus delivery gap puts inventory and margins at the center of the Q1 narrative. Second, JPMorgan's $145 bear case is re-anchoring valuation debate. Third, NHTSA closing the Smart Summon probe is a small regulatory positive, but the bigger FSD oversight continues. And fourth, Tesla's autonomy messaging is getting louder right as charging expansion in India shows incremental progress on the ground. For tomorrow, watch for more pre-earnings positioning and any additional analyst revisions ahead of Tesla's April 22 results. If you found this useful, subscribe to Tesla Daily News Podcast and follow us for your daily, data-driven Tesla and Tesla rundown.